So, good evening. Good evening to all the participants. Once again, thank you very much to all of you to attending our webinar. And again, thank you to Biva. She is every month she's bringing the new updations in the corporate taxation. Okay, and she is expert on that. So today, this webinar is being jointly held by Delphi and Horizon. Delphi is an education training institute, and we do training in different financial domains. Your like ACCA, CPA, CMA, CIS, CMT, so many courses we have. Along with that, we also have CFA, FRM, we have IFRS. So almost more than 200 courses we have. We also do corporate training. At the same time, Horizon Consultancy is a chartered accountant firm and management consulting firm, and they do consulting, audit job, management consulting, corporate taxation, and Biva is expert in corporate taxation, IFRS. So every month she's trying to bring the new like developments, whatever happening in the corporate tax, and that she will keep on doing it. So thank you, Biva, for attending. Once again, joining for the webinar, and let's start the session, Biva. Thank you.
Thank you, Shamji, for your kind words, and it was a nice introduction about Delphi and Horizon. So once again, good evening, everyone. Welcome to our fifth webinar, and we are trying to adding more awareness and knowledge about the most hot topic, UAE corporate tax, which is going to come in June 2023. But let's deep down into and let's see how it is going to impact our businesses and how we need to aware about this regulation so that we can prepare ourselves in advance before it will applicable on us. So first of all, we will talk about the rate of corporate tax. Just give me a minute. Yeah. So when we are talking about rate of corporate tax, how much it will be. So there are two rates defined. There are the few exemptions also defined in the corporate tax law. And other than those, all the incomes are taxable. Either it is 0 rated or 9%. So there are two rates are defined under the law on which corporate tax will levied on your income. First is 0%. So as per the recent update decision of cabinet, the limit they have defined 375,000, which is the limit for a taxable income. So if your taxable income, which means your profit, is less than 375,000, then the rate of tax on your income will be 0%. If you are in a free zone, qualifying free zone, and you are earning the income, qualifying income, then also 0% corporate tax will be applicable on your business on specifically to that income, that qualifying income. And other than that, the rate of tax will be 9%. So when we are talking about the qualifying income or qualifying free zone, still we need a clarity from the government side that what is considered as a qualifying income which will be liable for 0% tax. So currently the main challenges we are facing in our impact assessment, corporate tax impact assessment assignments, or the queries which we are receiving from our clients is how to bifurcate, because many a times a company is maybe it is in mainland and free zone, but it is involved in both kind of activities. Both kind of income are a part of the profit of the company. It can be a qualifying income and it can be a taxable income. Then when we are talking about the threshold of 375,000, then the challenge comes whether this qualifying income will be a part of that threshold. We need to calculate the threshold limit 375,000, including this qualifying income or excluding this qualifying income. So here are the tricky parts which will be clear with time, I think, when the detailed law will be there. But yeah, I think for the time being, what we can do, we can identify what can be considered as a qualifying income and what will be the non-qualifying income. The first thing is very clear that the income only in free zone can be a qualifying income. And there are other conditions also which you need to be satisfied. I will detailed on that during the session. But mainland income is going to be 100% taxable, and you need to calculate a threshold on mainland income, full income of 375,000. Any profit more than 375,000 for mainland companies is going to be taxable at the rate of 9%. So what is qualifying income in free zones? We will deep down that in the further slides. This is about the rate of tax. Now let's come to who are going to cover under the corporate tax, because it seems very easy. I always come up with this slide, who are going to cover under this under the purview of corporate tax, but it is very confusing when we talk about the natural person. So many people came up with that if a natural person is salaried also and doing side business also, with a small license or free zone license, whether this income is also going to be taxable. So I will say yes, the activities for natural person, the activities which require license, and if as a being a natural person you're involved in that activity, that you are considered as a taxable person under this corporate tax. Though it is named as a corporate tax, it is not a personal income tax, but actually it's a corporate income tax. So all the businesses are covered under this under the tax purview. So natural person is covered under the taxable person. If you are involved in any activity, any business activity which gives you a regular income, which is a part of business, as a natural person, you are also covered under the corporate tax. Legal person, any licensed company, in any form, either it is LLC, either it is free zone company, any trust, all are going to covered under the taxable person. Any person having PE in UAE, PE is permanent establishment. If you are outside UAE, either in form of a natural person or a legal person, but you have a permanent establishment in UAE, you are covered under the purview of taxable person. And any other exempt person which is specifically mentioned in the law, if you are from then you are covered under the taxable persons. Let's understand the concept of taxable person in two different, we divided it into two different scenarios. One is a resident person, another is non-resident person. So who is considered as a resident person, and why this bifurcation is required? Because for resident person, there is a specific kind of income which is taxable, and for a non-resident person, there is a specific kind of income which is taxable. For resident person, who is considered as a residence person, let's understand that, and then we will see which kind of incomes are going to be taxable if you are a resident person. If you are a judicial person incorporated in UAE, including free zone, then you are considered as a resident person. If you are a person incorporated in UAE, including free zone, including offshore, both, effectively managed and controlled in the state. State here is considered as a UAE. If the operations are effectively managed and controlled in UAE, you are considered as a resident person. Natural person who conducts a business in UAE is also considered as a resident person. Who is non-resident person? If you don't have any permanent establishment in UAE, you are considered as a non-resident person. What is permanent establishment? We will see that in next slide, few slides. If you are generating any UAE sourced income, if you are generating any for example, dividend from UAE companies, you are generating any real estate income from sourced from UAE, you are considered as a non-resident person, and you don't have anything in UAE, no fixed establishment, no license, either it is free zone. You are a natural person, but you are not in UAE, but you are still generating income from UAE. You are considered as a non-resident person. And if you have any nexus in UAE, that is also covered under a non-resident person. So this is the type of persons, resident and non-resident. Now let's see uh, which incomes are going to be taxable being a resident and non-resident. For a resident person, income from inside and outside UAE is going to be taxable. So if you are a resident person, let's go back to the slide of a resident person. Either you're registered in UAE, you are effectively managed or controlled in UAE through PE, you are a natural person, conduct business in UAE. If you are one of them, any income arising from UAE or outside UAE is going to be taxable in UAE, though the foreign tax credit will be available to you for your foreign incomes. So in layman language, if I will say, if you are a resident, from the tax perspective, your foreign income is also going to be taxed in UAE. If you have paid any tax on that income outside UAE, in that country from that income is coming, then you will get the tax credit of that income. For a non-resident person, if you have any income which is attributable to your permanent establishment or sourced from UAE, is considered as a taxable income. So for a non-resident person, if you are having any income from UAE, that is going to be taxable in UAE only, though you are a non-resident person in UAE. Now let's see the examples of what type of income can be a income sourced from UAE. So first is, if any income is derived from the resident person, if you are having any income which is from a resident person, either it is form of a rent or any other way, it is going to be considered as a UAE sourced income, and it is taxable under the UAE corporate tax. Income on sales of goods, on the if you're providing any services, income, interest income, any insurance premium, reinsurance premium, income from movable or immovable property in UAE. If you have any income on the sale of any movable or immovable property, that is considered as a UAE sourced income. Now let's come to let's try to understand what is permanent establishment, because if you have a permanent establishment in UAE, then you are considered as a resident of UAE for the tax perspective, and your all the incomes which is foreign income or UAE sourced income is taxable in UAE. So the purpose of determining permanent establishment is, if and when a company has established sufficient presence in a foreign country to warrant that direct taxation of that profit of business profits in that country, is the main purpose to understand permanent establishment. There are two tests which you need to perform to identify whether that organization is considered as a permanent establishment or not. First test is fixed place of business test. Second test is dependent agent test. So what is fixed place of business test? Fixed place of business test is, if the management have an office or a factory or any real estate property, building site, where the activities are carried on for more than 6 months in that premises or in factory or in any real estate property, that this means that that business have a fixed establishment in UAE, and that is considered as a permanent establishment. And if any foreign business have a permanent establishment in UAE, it is considered as resident for the perspective of tax. Any preparationary or auxiliary activities are not included in that. So if you are only included in any research kind of activity, or a which is the kind of activity in the preparation of your business, that is not considered as a business for the PE perspective. So those activities are not considered, or you can say qualifying for permanent establishment, and these are not forming a part of a resident in UAE. I can see there are the few questions are coming up. What I request you guys, we will take the questions in the end of the session, or in the end of the session, you can see my email is also there. You can email your questions there. Just note it down your questions, and then we will come to the question in the end. The subject itself is a little bit confusing, so of course the question is going to become, but bear with me, because there are 3-4 more slides to come regarding this topic only. Maybe you will get your clarity in further slides. If you will not get, then we will have a questions in the end of the session. So this is one of the test is fixed place test. If you have any real estate property or factory or building where you are carrying the activity of business for more than 6 months, you are considered as a permanent establishment. Second test is dependent agent test. So if you have if the business is having a person in UAE, based in UAE, who can conclude the contracts or act on behalf of the foreign company in UAE, that is considered, that qualify the test of dependent agent. And this means that that company is a having a permanent establishment in UAE, because that person don't require any intervention or any approval to finalize the contract or any act on behalf of the company. This, if the company is involved in with any agent whose ordinary course of business is to do the same kind of work in general, then that is not qualifying as a business dependent agent test. For example, let me give you example, because it's little bit complex. If a foreign company is having a person who is into the sales or marketing, and that person is fully dedicated to that company only, concluding the contracts on the behalf of company, acting as a what I will say authoritative person on behalf of that company. There is no approval required from the foreign company to conclude any contract. That is one of the example that is clear, qualified for dependent agent test. The another is, there is a marketing company who do marketing for on behalf of their clients, and the foreign company is involved with this marketing company, and this marketing company main course of business is doing this kind of job for many clients. Then this foreign company will not be considered as a permanent, have a permanent establishment in UAE, because there is no dedicated full-time employee or person to this company who is working on behalf of foreign company. So this is a dependent agent test. So there are two type of tests. If any foreign company qualified in any of the tests, it is considered as permanent establishment. If it is a permanent establishment, it is considered as a resident in UAE, and then those income which is sourced from UAE is going to taxable in UAE. I hope I made this little bit easier in the summary form. Let's go back. Let's come to this foreign tax credit. So if you are a resident, your income outside UAE is also going to be taxable in UAE, but you can get the foreign tax credit of that which you have paid in any other country other than UAE. That is considered as a foreign tax credit. How you will get it? When you are filing your returns and assessing your liabilities, then we are expecting that there will be the place where when you can get your foreign tax credit, but there is a limit on that. So what is the limit? The tax paid in the foreign jurisdiction, or the UAE corporate tax payable on that foreign sourced income. Whichever is the maximum, you can get the credit of the same. So if we are talking about that thing, it means The corporate tax rate here is going to be 9% on the foreign sourced income also. If you are paying more than that income tax in foreign country, you will get the credit of that up to the 9%. More than that cannot be carry forward. So your full income will be exempt, kind of, if you will take this foreign tax credit. Because we need to consider this thing that in UAE the 9% tax is there, and which is kind of minimum tax if you will compare with other developed countries or even developing countries when it comes to the tax. If we take the example of India, it's 25%, many places it's 19%, 20%. So 9% is the minimum one. If you will see the global minimum tax also, it's 15%, but they have introduced it with 9%. So if any income outside UAE is there, they are going, and you have paid tax on that, it should be more than 9% majorly. So you will get the credit, full credit of that tax credit, and whatever is left after that 9%, that is you cannot utilize that for any other thing. It's a kind of like unutilized credit for you, but you will get the credit on your foreign income. Now, this is also a very important part when we are talking about being a resident. You need to pay tax on your foreign income in UAE. So there are already double tax treaties of UAE with 100 countries. So there are the different models of double tax treaties: OECD model, UN models, and US models. So these are the models of double tax treaties are there, and UAE already have 100 around 100 double tax treaties. So we, on the type of income, we need to assess that also, that with which country UAE have the double tax treaty, and how it where the income need to be taxable. So on that basis also we need to take help when we are assessing the taxability of foreign income. Now coming to the last slide, I think, of foreign income. So there are two ways of taxing foreign income. One is withholding, another is foreign tax credit. What is withholding tax? The following income will be subject to withholding tax: the state source income, the UAE sourced income to non-resident, which is not related to PE, is going to be liable for withholding tax. So if any non-resident who don't have any link to UAE, but they are earning any income from UAE, in my previous slide, I'll give the example of real estate. If any non-resident, he don't, like a natural person, he is not staying here, he's not working here, he don't have any business, but he have a property here and he is earning capital gain on that property, or any other kind of state source income, maybe in form of rent or anything, that is liable for withholding tax. And currently, as per the cabinet decision, the withholding tax rate is 0%. So there will not be any deduction of tax, but we are expecting that the reporting of the same will be there. How it is going to be reported, that is a little bit, I think the new thing will be there. But we will not be surprised if UAE authority will come up with the new things, because as we know, in the current VAT structure also, they have VAT refund structure and other things are there, so they can fetch the data, they can see from what where is going, and it's very easily manageable from their side. But the reporting part will be there, because this withholding tax currently is only 0%, but if you will see in any other countries, whether it is GCC region itself, Bahrain or Saudi, they have a slab of withholding tax on the type of services. It is 10%, 12%, 18%. So we are expecting that here it will come slowly and gradually, but they have introduced the concept of withholding tax. That means that there will be the deduction of tax if any non-resident is earning from here, and maybe to get the exemption for the same as other countries have, they must require the tax residency certificate or anything. If they don't have that, then it is going to be there for sure. Currently, only this is for non-residents, but cabinet have power. If they want to add any income in that, they can do that. So this is about withholding tax. Then foreign tax credit. Foreign tax credit, any tax paid outside UAE on the income on which UAE corporate tax is also payable, that is considered as a foreign tax credit. As we discussed in the previous slide, that any tax which is paid outside UAE on the foreign income is allowed. You can take the credit of the same. Foreign tax credit is not available more than the tax payable in UAE. So that is the 9%, as we discussed in the previous slide. Now, this was all about the foreign income, UAE sourced income, resident, non-resident, which income will be taxable in the hand of non-resident, which income will be taxable in the hands of resident, who is considered as a resident, who is considered as a non-resident, what is permanent establishment, what are the tests of permanent establishments. So those are related to the basic concepts of corporate tax when it will be applicable on you. So this is also one of the very important part, I will say, when it comes to the free zone, because everyone have the curiosity to know whether the income of free zone is taxable or not. So here is the article regarding the same, very small one. We are expecting a lot of clarification in this part, because this is really this is giving a very vague picture actually. So according to the latest clarification in the law, the qualifying free zone are exempt from not exempt, are liable to have a 0% tax on their income, who is considered as a qualifying free zone if they derived the qualifying income. So what will be the qualifying income? They are going to issue more clarity on the same. But as a qualifying free zone, they need to have an adequate substance in state. So we are assessing that this adequate substance is something related to economic substance regulation. They are correlating. So if a business want to have a want to claim this qualifying income and qualifying free zone exemption, then the business should have adequate substance in the state. That is one of the most important condition. The business must comply with the provision of arm's length principles and transfer pricing documentations if it is applicable. So if we are talking about the arm's length principles and transfer pricing, it covers those transactions which is with your related parties. So if you are dealing with your related parties, then you need to comply with all the transfer pricing regulations. With that, some of the free zone mentioned that they are the tax incentivized. So what is the meaning of tax incentive wise? Must have heard from many free zones that they are exempt from tax or income tax or corporate tax for 50 years, for 20 years, for 30 years. So the free zone authority have that power, that they already exempt from tax for few years, and that is only if they are claiming that they are exempt up to 60 years, 70 years, that is not allowed. They are allowed only for 50 years, but at least the free zone should have that provision in their law that they will be exempt from the corporate tax. Then if your business is there, you can opt for exemption if you are doing qualifying income. So this is the clarity for the time being when it comes to the free zone. There is no, I will say, black and white kind of clarification that we will say that this income is not taxable, this income will be taxable. Even for our current clients, they are having the challenges to identify. So what they are doing, they are structuring their operation so that they bifurcate all the qualifying income in one company and other income in another company, because we are expecting that qualifying income will be majorly related to exports, or within a free zone. Within a free zone is not much. We will say that 100% it will be in qualifying income, but for sure, whatever the income is 100% dedicated to exports, that is going to cover under the qualifying income. This is, we can say, on the basis of the consultation document they have published. So we are expecting that this will be the definition of qualifying income, and on that basis, we are bifurcating the operations of free zone, or rather than free zone, I will say the exports income and the mainland company income. Because if the joint income are there, then it is very difficult to proportionate the expenses and to then come into the litigation and explain to the authority that this expense belongs to this income and this belongs to this income. So practically also that is not that feasible. So clients are structuring their operations in that way. They can bifurcate the things accordingly. Now they have mentioned the few non-deductible expenses also. So as we know that corporate tax will be on the profitability of the business. It is on the down line of the bottom line of the profit and loss. So there are the few expenses which they have mentioned specifically that it is not going to be allowed as a deduction from your income. First of all, that is a recoverable input VAT tax, which you are claiming as a credit in your VAT returns. That is not a deductible expense. Any corporate tax or any foreign tax also you have paid outside UAE is not allowed as a deductible expense. Any donation, grants made to any entity that is not a qualifying public benefit entity is not considered as a deductible expense. If there is any qualifying public benefit entity, like there is a dedicated charity, they must come up, must come up a list of the organization which is they have defined for the public benefit entity. If you are making donations to them, grants, gifts to them, then that is fine. If not, then it is a non-deductible expense. You cannot get the expenses, deducted expenses of those donations. Any fines, any penalties are not covered, allowed as expense. Dividend, profit distribution, or benefit, or any other benefit of a similar nature paid to the owner of the business is not considered as expense. Amount withdrawn by a natural person from their business. Many person will come with a tax planning that they can have a salary, the maximum amount, and these are not allowed as a expense to the business. So here is a little bit more clarity is required. It's not that as a business owner you cannot withdraw amount from your business. You can of course withdraw. You are dedicated your time and efforts and you are qualified, but it should be as per your qualification. It should be a regular practice. You are continually withdrawing that amount of money from your business as a salary or as a remuneration. That will be allowed. But it's not like that suddenly after the corporate tax introduced, your that amount is you increased by 200 and 300%, and now you're claiming that this is your salary. That is not going to be allowed. Then under the transfer pricing regulations, if there is any this kind of transaction will also covered under the transfer pricing regulations. So then it is the liability of the businesses to explain the same, that if you are withdrawing that amount, what is the reason behind that, or are you legit for that? The documentation and everything you need to prepare. So this is one kind of non-deductible expense. Any bribes or any illicit payment if you will made, that is also not deductible. Tax on income imposed on the taxable person, any kind of tax is also not allowed as a deductible expense. So this is a small list of non-deductible expense. Other than that, you can claim all the expenses from your P&L as a deductible expense. The next is there is a restriction on the interest expenditure. the interest expenditure, if your business structure is like that, your business is having good facility and your interest expense is quite huge, then you need to check on this limit. There is a 30% cap on the interest expense. So that 30% should be the accounting profit before EBITDA. So your interest expense will be allowed only 30% of your EBITDA. If any interest is left after that, you can carry that interest up to 10 tax periods. Like you can carry forward that interest expense, which is more than 30%, and you can claim in the subsequent years. But in that particular year, it is only allowed as a 30%. Then there is one more crux in that, that interest deduction is not allowed if it is related to related party in form of dividend, profit distribution, redemption, repurchase, reduction, or return of share capital. So if your interest expense is related to those kind of expenses, then it is not allowed as a deduction if it is related party. So this is a restriction on the interest expenditure. Then coming up to a very known terminology, entertainment expense, we have a limitation in VAT also when it comes to the entertainment expense. So in corporate tax also, they have come up with a restriction that any kind of entertainment expense is allowed only up to 50% of the total expenditure. So what is entertainment expenditure? It includes which expenditure is incurred for the purpose of receiving, entertaining the taxable persons, customers, shareholders, suppliers, or any other business partners. If you have made any expenditure to entertain these people, that is only allowed up to 50%. These expenditure can be of meals, accommodation, transportation, admission fees, facility equipment used in connection of entertainment, amusement, or recreation. Any kind of these expenses are allowed only up to 50%, even though it is for your own business. Come to the next topic, tax losses. So we have talked about the profits. Profit is going to be taxable up to either it is 0% or 9%. But what about the losses? If you have a losses where you are getting 9% from the government, no, it's not like that. You are not getting anything from the government, but you can adjust those losses in your future profits. So tax losses of 1 year can be adjusted in subsequent tax years up to the 75% of the taxable income of that taxable period. So in the next, for example, in year 1, you have a loss, and in year 2, you have a profit. So whatever the profit in year 2, 75% of that profit you can adjust with your loss. On 25%, you need to pay 9%. So 75% is adjustable, and whatever loss left from the year 1, you can adjust that in the 3rd year. So this is a cycle they have defined when it comes to the tax losses, but there are few conditions you need to meet to claim these tax losses. First of all, both the taxable person are judicial persons. So both the persons are judicial person, mean both should be legal person, or both should be it should not be like that one person is natural person and one person is legal person and you're adjusting their losses. No, if we are talking about, for example, let me take an example. If a natural person is having a business in a proprietorship name, and there is another company where he's a partner, and the losses of both the companies cannot be adjusted. It if a natural person have two different companies, and the both of those two companies can be adjusted together, profit and loss, but not if the judicial persons are different. Both companies having the same partners, they can adjust their losses together. The direct or indirect common ownership of at least 75% is required if you're adjusting your tax losses. None of the person are qualifying free zone person. If you are claiming any exemption, being a qualifying free zone person, you are not eligible to adjust your tax losses. Both the taxable persons are resident persons, non-resident and resident person cannot adjust their losses together. None of the person is exempt. There is a list of exemptions in corporate tax. Any exemption person cannot adjust their losses with one taxable person. Having the same financial year and follow the same accounting standards for the preparation of financial statement is one of the most important condition when we are talking about adjusting losses with each other. This same financial year is easy to manage, but we have a client who have the problems when we are talking about the same accounting standards for preparation of financial statements. So when we are talking about the accrual accounting, when we are talking about the cash basis accounting, it has to be same. So the preparation of financial statements should be on the same accounting standards. Then only you can adjust your losses. Then we have the same concept of tax group which we have in VAT. So in VAT we have few conditions on the basis of which you can register yourself as a tax group. The same way in corporate tax, if you are registered yourself as a tax group, they are the condition. First condition is the resident person are judicial persons. Both the person should judicial. The parent company owns at least 95% of the share capital or voting right in the subsidiary. The common shareholding is 95%. Neither of the parent company nor the subsidiary is an exempt person. Both the persons should be taxable. Then you can form a tax group. None of the persons are qualifying free zone persons. If one company in free zone, one company in mainland, you want to form a tax group. In VAT, you are already a tax group. You cannot do that if you are opting 0% exemption for your free zone company. You cannot form a tax group if you are availing the exemption of qualifying free zone person. So that is a very important point when you are planning to register yourself. Being a exempted company, you cannot form a group with the mainland companies. If you are ready to pay or you are in the planning to pay corporate tax in the free zone companies because you don't have any qualifying income, you can form the group with the mainland. But if you are not, then both the company need to be registered separately. Both the companies who are looking to have a tax group having the same financial year follow the same accounting standard for the preparation of financial statements. So this is also a very important point, because being a type of business also sometimes it's challenging to follow the same methods. You can follow the different method, but you cannot be part of tax group in that way. If it is not possible in your group of companies to follow the same accounting method for the preparation of financial statement. So this is about a tax group. One more important thing I want to mention here is being a tax group. I talked about the tax losses before that you can adjust your losses being a group of company if the 75% shareholding is common. So if you're not registered as a tax group, even though you can do that, but if you're registered as a tax group, then your returns will be one. Then your full income income or losses you can merge, and your liability will come accordingly. But if you're not a tax group, you have a 75% common shareholding, you can go for this tax loss adjustment within a group companies. Then as we know that here the VAT and corporate tax now both direct and indirect tax is there. So before finalizing both the reporting parts, we need to reconcile both the things, because both the information is going to FTA and there should not be any clash between both of them. So what are the points which we need to take in care? Entertainment expenses both are common. In one, we are saying that there will not be any input tax credit available for entertainment expense. In corporate tax, we are saying that 50% is disallowed. So that we need to take care that it should there has to be some correlation between the entertainment expenses when we are claiming that input tax credit is not allowed as expense under corporate tax, and it is allowed as an input tax credit while we are calculating our VAT liability. So it should be reconciled. Directors remuneration is one of the most common point between them. Recently, FT came up with the amendment in directors remuneration in consideration to the VAT. Previously, director's remuneration comes under the purview of VAT, and if any director is getting remuneration of more than 375,000, then that director is liable to register for VAT and need to collect VAT on need to pay VAT on that. But when the introduction of corporate tax came in the picture, they have amended. Now the director's remuneration is not under the purview of VAT. But when we are talking about the corporate tax, we need to see the allowability of director's remuneration as an expense from the corporate tax perspective. Reverse charge is most common negligible kind of reporting by most of the businesses. Reverse charge liability comes in two ways when you are importing any goods or services. For goods, it is automatically coming, so majorly it is reported, but majorly businesses are missing on the reporting when it comes to the importing of services. So when you are claiming as an expense that you have import a service and you are claiming that as an expense in your profit and loss account, make sure that should be reported under the VAT returns as a reverse charge under the reverse charge mechanism also. Import of service is very one of the most negligible reporting most of the businesses are doing. Capital expenses is also one of the most important thing which you need to take care under VAT. Capital asset scheme is there, so we need to take the credit in the first year, and then we need to account it further that if there is any sale or anything of that capital asset, then we need to reverse it. In the on the contrary, in the corporate tax, we will have a depreciation. Currently, there will not be any defined rate of depreciation. They have mentioned the corporate tax, but there will be the depreciation on the capital expenses and the VAT liability, the input liability which we have input tax credit, which we will take under the VAT, is not eligible for the depreciation part. So other than VAT, whatever will be the cost of capital asset, that will covered for depreciation. So there are the few correlations between the VAT and corporate tax which you need to take care. Then one of the very I will say the big regulations from the compliance perspective, transfer pricing is introduced by FTA in corporate tax law. So transfer pricing is a quite having a wide range of compliance. I will say it will be applicable in layman language. If I will talk about, it will be applicable to those transactions which is with the related parties. So as a business owner or as a finance manager, you first need to do mapping of those transactions which are with the related parties. Then those transactions should be as a transfer pricing, should be as a arm's length price, the same price if you are which you are dealing in the market, it should be the same. And if it is not, then why it is not, that you need to explain. And for that explanation, you need to prepare the master file and local file. Like if I can simplify the transfer pricing regulation in the simplest manner. So this is the explanation. Here in UAE, there are two kind of transfer pricing. What is international, one is domestic. So generally, majorly the international transfer pricing comes in the picture, but in UAE, the domestic transfer pricing is also there, because here there are two jurisdictions in UAE itself, being a free zone and being a qualifying income. I will say the qualifying free zone income. We have one 0% tax jurisdiction and one is the 9%. Other than that, so if any transactions between both of them, that is covered under the domestic transfer pricing, if the transactions are between the related parties. So we need to comply the transfer pricing regulations. According to that, they have come up with a list of transactions also, that if you have those transactions, these transactions will cover under the transfer pricing regulations. But still, like the qualifying qualifying income required more clarity, this also required a little bit more clarity, that what we need, how business needs to prepare for that. Then last but not the least, these are the things you have to do. Either you are a very small business or you are a group of MNCs. These things you need to do. First of all, reconcile your VAT returns with your financials, because your financials are going to be the base to prepare for corporate tax. So it should be reconciled what you have filed in your VAT returns. Read the line items of your trial balance, work on that. There has to be things which you need to work out when it comes to the income recognition, expenses, deductible expenses. We have came across the clients who have the credit items. They have the incomes which is coming outside UAE in form of dividend. What will be the treatment of those? Other than other incomes, you need to see what will be the treatment of those income under corporate tax. If are you claiming any expenses related to those incomes or not, that you need to see. Get your finance team trained and ready for this big change, because this is not a kind of change that you have to charge 5% on your sales and you just need to report that. It is more than that. It's more about, it's a kind of full report of your financial performance. So you cannot change anything once the report goes. So you need to prepare it very properly. Prepare a mock-up tax returns of previous year. So if I'm talking about the previous year, this is your previous year. If you're following the financial year of January to December, then at least you need to have a mock-up tax return from January 2023 to December 2023 in your hands, so that you know what will be your liability in the next year. So these things you need to do from your side. And yeah, thank you very much for your patience and listening. I think now we can have questions from the audience. Shamji?
Question, please put your questions, Shyam, or raise your hand.
Put the questions. Yeah, you can put the questions in the chat box if you have any. And if you still think that, you know, it needs to be more, you need to elaborate more, here is my email address. You can post your questions on this email address also. I saw a few hints.
I think Badar want to ask anything. Okay.
Yeah.
So Badar, yeah, Badar, I allowed you to talk. Please tell me.
You are on mute, Badar, I think.
Badar, you are in mute. Yeah.
Yeah. Now I can talk.
Yes, Badar.
Yeah. So actually, I just joined. I forgot to join at 4:30, and because I just recently started a new job, so I was busy. So that is the only reason. Yeah.
Congratulations, Badar.
Thank you, sir.
Thank you.
Welcome. Sir, any slides we can get for this presentation?
This flight is not possible, but you know, we are keep on uploading your webinars in the YouTube. You'll get that from us, no problem.
Okay, okay, okay. Nice to talk to you, sir.
Yeah, great, great. Nice to talk to you as well.
Yeah, yeah. Thank you, thank you.
Thank you. Anybody have any question, doubt, anything?
I think there are few hands also coming up.
Yes, Mr. Saka, please tell me. Please suggest, sir.
Hello, sir. You can hear me now?
Yeah, yeah, I can hear you. Please.
Yes. First of all, thank you very much for this explaining. It was really helpful. My question was for what about the standard of calculating the CT? Is it for the total income or the net income?
It is for the net income, your net profit. It is not
Net
your
income.
sales. Yes,
So I
it
will
is for your
calculate-
profit.
Okay, I will calculate the 9% for the net income. But if
Yes,
what's the
yes.
standard of what's the standard of the 375,000? Is it for the
Yes,
is it for the income or the net income?
net income. It is for the net
Net
income.
income. That means we are talking
Yes.
about the net income.
Yes, yes.
All right. Okay.
It's all about the net income here.
Yes, and because VAT, of course, that is we are talking about income actually.
Yes, in VAT, it is on income, it is on sale, but the corporate
Yes.
tax is on the net income, the profit.
That's fine. And my second question is, if all of the standards are or all of the tests are telling that we have to make the corporate tax, but we don't have a fixed office. So like we have a virtual office.
Okay,
Like
Sorry.
some companies are making them trade license with a virtual office only for the trade license, and they are working like in a commission basis like that.
yeah, but if they are crossing the threshold, they will be liable for corporate tax.
That
Because
means,
they must be resident in UAE and they are doing business in UAE.
okay, that's clear. Thank you very much.
Yeah, yeah, thank you.
And Vidya, what is the threshold for the corporate tax?
The threshold is 375,000.
That is should be the annual income,
Yes,
annual net profit.
annual net profit.
Should be 375,000 or more than that.
Yeah, more than that will be taxable. If up to 375,000, it's exempt. Exempt like zero rated, you will say. Yeah, yeah.
Okay, okay, okay. And in corporate tax, what are the main things we need to consider? Because I just joined, I am late. It's my fault. So if you are able to just guide me for few lines, I need to take care. Then I can work from my side. Yeah, just give me a little brief on corporate tax.
I think the little
Brother,
brief.
there is
will
no
be
problem.
little-
Brother, we can do one thing. You contact our team. They will share with you our some videos. You can take from there because it's a fifth series of webinar is going on. Okay. And we will not be able to explain everything to you within 5-10 minutes.
Yes, yes, yes.
So I just contact tomorrow our team.
And we have other attendees also, I think,
Yeah.
who are raising their hands.
And you are our old student, so there's no problem, brother. Huh?
Thank you, sir. Thank you. Okay, so I need to contact your team.
Yeah. Contact my team. They will help you. Don't worry.
Okay. Thank you, sir. Thank you.
I think we have Dujesh also have some questions.
Yeah. Just tell me any doubt you have.
Just I need to ask now.
Just one more question. Sorry, am I audible?
Yeah, audible.
Firstly, I think I want to thank Viva for excellent explanation and very detailed presentation.
Thank you.
You made a lot of points very clear, and it made a lot of clarity actually. I have one particular question. and you touched upon the withdrawal by the entrepreneurs from their own businesses, be it
Yeah.
salary or managerial remuneration, because this particular line item is very important in this part of the world. As you know, a lot of people, a lot of
True.
entrepreneurs, individuals, they run their own businesses, and based on the profitability of the business, they withdraw their own salaries.
Yeah.
And
Yeah.
this, I know it's little bit debatable at this point in time, because in the law, what is published, there are multiple interpretations you can take. Somewhere it is written it is not allowed, and as you mentioned, based on individual's qualification, experience, there is some sort of threshold they should allow or they will allow. I don't know. Can you please throw some light on that, Viva?
Yeah, so this is as you mentioned correctly, actually, it will be allowed. See, you being an individual, if you're a business owner and there is a fixed expense as an employee, also, if you're working, there is a fixed expense of yours also. So you can take a salary anyhow. You cannot, I don't think that authority will, 100% disallow that. But we have in the law, we have read that also, that it will cover under the transfer pricing regulation. So being a business owner, if you're single owner, you're withdrawing salary from your business, so you are a related party to a business, then it will come under that transfer pricing regulation, if you can explain that. So that makes a confusion, if it's not allowed, then if it is allowed, then why it is not allowed, then why they're covering it as a transfer pricing under the transfer pricing regulations. So as I mentioned that in that slide also, I think we need a little bit more clarity on that. But it will not be that it will be fully disallowed. From my perspective, it will be difficult, from the practically, if we will see also.
Yeah, it will be something interesting to see how people react to this, and how the regulators are going to, design the regulations around this, because we see a lot of clients, individual business, as I mentioned earlier, based on the profitability at the end of the year, they just put their own salaries and, sometimes suppress profit, sometimes they take less salary just to show more profit, depending on the requirement of the business. They play around this particular line. Yeah.
True.
All right. Thank you. Thank you for the answer.
Thank
and
you.
again, very good presentation. Yeah.
Oh, thank you, sir. If you're complimenting, that means a lot. Thank you.
Thank you.
So anybody has any other question?
I think we have Muhammad. Yeah, there is a Q&A, this also. There is one question from Ursal. Is there a source from UAE government that can be downloaded as a guide, and where can we access it? Yeah, from the FTA side, their new portal Emara, you can get all the information about the law is already there, so you can get it from there.
See, basically, the law is definitely there. You can download the whole law. But as I said in the beginning also, that for the corporate tax, we are conducting the training also. And Biba is going to be our trainer, one of the trainers for the corporate tax. So she will explain the whole thing in a simplest way. And also she is a chartered accountant and working with a consultant. And tax is her major area. That's the interest area what she's practicing for last more than 10 years. So she will be able to explain the things in a more simplified way as per your requirement of the industry. Because in the booklet, it is very big and difficult to understand all and everything from there.
Yes, I think we have one more participant, sir, Muhammad Mehdi.
Yeah.
Yeah, we can ask.
Yes, Mr. Muhammad.
Hi, am I audible?
Yes, audible.
Yes.
Thank you so much. First of all, Vibha, thank you for this really clearing the concepts and everything. And secondly, my question is regarding the registration for the corporate tax. Like, are we going to receive, the businesses are going to receive any specific link or invite to register, or like, is it, it will be open for all? Like, how is going to be the registration mechanism? Is there any like guideline as of now from the FTA?
Yeah. So it is like that. You're going to receive emails from FTA. You cannot register yourself just like it was not like VAT. it is going to be different. You will receive emails from FTA that you are liable for corporate tax and you need to register it. So this is the information we have, and few people, few businesses received also, and the process is in that. So they are going to do that in phase wise. So currently the big business is only receiving the emails, the big MNCs group and all, and they are asking about their financial years, their revenue and everything. So small businesses will also get, and we are assessing from the few clarifications that all business need to be registered. So it is not going to be that if you are exceeding more 375,000, then only you need to register. All need to register, and whatever the income you are having, you need to report that. Maybe your tax liability will not be there because you're not exceeding the threshold, but the reporting part will be there. This is the clarification we have currently.
Okay, so that means the return will have to be filed whether or not our corporate tax liability crosses the limit. But at the same time, like for example, if we don't get to reach that limit of 375,000, are we like, or we close our books in losses? So, like, is there a mechanism where they will allow us for the refunds or something?
Refund will not be there, Mr. Mehdi, anyhow, because you are not entitled for any refund under corporate tax. You can adjust your losses in your upcoming year profits, as I mentioned in my slide, that if you have losses in year 1 and you have a profit in year 2, you can adjust your losses, but there will not be any refund in corporate tax because there is no deduction in this corporate tax like we have in our India. TDS is there on salaries and everything. They are not deducting your tax from any income source. So currently there will not be any refund mechanism. There will be only adjustment of tax losses.
Okay, thank you. Thank you so much. Thank you.
Yeah, welcome. Thank you. Yeah, I think we can finish the session, sir.
Yeah, thank you. Thank you very much. Thank you, Biba, again for such a wonderful webinar. And
thank you, sir,
again,
for having
thank
me
you to
once
all
again.
the participants for listening us so patiently. And definitely, again, you will come back with our another series of webinar with more information. Thank you. Thank you to everybody.
Thank you, everyone. Thank you. Have a great weekend. Bye-bye.